Tether's drift rescue is the clearest sign that this week's crypto move is about control, not just price. Actually, week starts with a Solana trading platform hit by an approximately $285 to $295 million exploit on April 1, then handed a $127.5 million Tether commitment inside a broader package near $150 million. The unusual part is the structure. This was not framed as free support. The commitment is tied to Drift's future performance, and the terms push Drift away from USDC and toward USDT as its core settlement layer. That makes the first story a competition for payment flow inside DeFi, not a simple bailout headline. That detail turns a rescue into a stablecoin power play. Settlement layer means the asset used to move value inside the protocol. If Drift's activity runs through USDT instead of USDC, Tether gains a stronger position in a Solana DeFi channel that Circle was positioned to contest. The exploit created the pressure point. Tether stepped in when the protocol needed capital and confidence. The practical consequence is that one security crisis may also reshape who controls the stablecoin rails inside a key trading venue. The second force is Bitcoin demand through regulated wrappers. Bitcoin approached $76,000 while total crypto market value moved above the $2.56 trillion area. The market picture points to institutional ETF buying, including BlackRock-linked demand, rather than a retail-only rally. That matters because ETF flows change access. They let traditional accounts get Bitcoin exposure without handling wallets, exchanges, or custody. In Actually Week, the rally is real, but the driver looks more like institutional allocation than a sudden return of retail euphoria. ETF demand also changes the type of buyer involved. A retirement account or advisory platform behaves differently from a trader moving coins between exchanges, so the rally can feel strong while social attention stays uneven. The third force is a fight inside Bitcoin development. BIP 361 proposes freezing coins in quantum-vulnerable wallets if holders do not migrate after a 5-year grace period. The affected estimates range from 1.7 million to 5.6 million BTC, including early outputs where public keys are exposed. Supporters see it as preparation for future quantum attacks. Critics see it as a threat to Bitcoin's finality because dormant coins could lose normal ownership status without active migration. That is not a price chart issue. It is a rule of ownership issue. The sensitive part is consent. Dormant wallets cannot vote with activity, which is why the proposal creates pressure between future security and the original expectation of permanent ownership. A fourth layer is social noise. Coordinated promotion can appear when institutional momentum pulls attention back to crypto. The warning sign is not enthusiasm by itself. It is multilingual hype, airdrop bait, emoji-heavy posting, and tokens that need retail volume more than they need real usage. That sits next to serious stories like Drift settlement change and ETF access, but it does not share the same logic. One side is infrastructure and capital allocation. The other side is attention harvesting. The useful read on Actually Week is that crypto is moving for several different reasons at once. Drift shows stablecoin competition through rescue terms. Bitcoin shows ETF-driven access. BIP 361 shows a security debate that could touch old coins and ownership rules. Social hype shows how quickly weaker narratives try to ride the same session. The next signal is which force keeps producing observable follow-through. Drift settlement usage, ETF inflows, developer response to BIP 361, or retail volume chasing promoted tokens.